Our next guest is no stranger to the M&A landscape. Over the past 2 years, the company has significantly expanded its operating areas in the Eagle Ford, Bakken, and Marcellus. Magnum Hunter Resources has recorded huge production and reserve increases and has been drilling longer laterals, equating to more productive wells in the Eagle Ford. Here to talk about the company's operational profile is Gary Evans, Chairman and CEO of Magnum Hunter Resources. Hi, Gary.
Hi, how are you doing today?
I'm great, thank you. Now, your company is approximately 50% oil and 50% gas on a reserve basis. In a time when natural gas prices are sub $3 and oil prices are around $100, how difficult does it make capital allocation decisions?
Fortunately, the way our company's positioned with being actively involved in 3 shale plays, 2 of which are oil, being the Bakken and the Eagle Ford, we have the ability to shift our capital around. So we've just made the decision just in the last 45 days to move capital out of the Marcellus, which is 75% gas, 25% liquids, into the capital programs of the Eagle Ford and the Bakken. And so we're in the process of doing that. We have a $200 million budget that we announced preliminarily late last year. We'll be revising that and announcing to the public in the next 30 days about how we reallocated that capital.
From 2010 to 2011, you grew reserves and production by 235% and 237% respectively. What's driving these results?
These shale plays is just incredible. We've been having improved results in all 3 of the regions that we're active in. We're adding reserves to the tune of about 4.5 million barrels a month. And that enabled us to have 6 borrowing base increases just last year. And so continuation of this drilling factory, this mode that we're currently in all 3 plays is our game plan for 2012.
Now, your company has historically grown through acquisitions as well as organic drilling opportunities. In 2011, you replaced your production by nearly 10.8 times. What portion of this growth was driven through the drill bit?
Almost all of our growth in the second half of 2011 was drill bit growth. That 4.5 million barrels a month growth I just mentioned all came from the drill bit. So the earlier part of the year was really getting the base of the assets we needed in those areas. We're continuing to do smaller bolt-on transactions. We just announced a transaction a week ago in the Utica. So I think you'll still see us do transactions that are very opportunistic in the regions we currently operate, but most of the growth will be from the drill bit like it was in the last half of 2011.
Can you expand more about your Utica shale acquisition?
Yes, we've obviously been looking at Utica hard because we're very active in the Marcellus on the western side of northwest West Virginia. The Utica is on both sides of the Ohio River in West Virginia and Ohio. We've been looking for acreage in Ohio that's near us, and we had an opportunity to make an acquisition at a very attractive price, around $2,000 an acre, and which was about a $25 million transaction we announced last Friday. And that gave us a lot of acreage in predominantly one county, Noble County, some in Washington County, that's adjacent to acreage we already had. So this is a part of the Utica that we believe is very liquids rich, almost to the point of being oil, and very condensate rich, and so we plan on doing our first test this year.
Great. Now, this isn't your first go-around in the oil and gas industry. Previously, you built and sold an E&P company for $2.5 billion. Now, what did you learn in that endeavor that you're applying to your company now?
Well, we've built a company just in 2.5, almost 3 years now, that's $1 billion in equity market value today. It took the last company 20 years, so I'm moving faster. I'm getting older, so got to do a little faster. But I think what's really different between the old Magnum Hunter, the first go-around, and where we are today is that company was built on buying properties from the major oil companies. They were all leaving the United States in exodus, headed to international markets or deep water. And this go-around, it's all resource-driven. Our company's 100% unconventional resource plays, and now those major companies who we were buying from in the past, they're my biggest competitors today. They have come in and tried to duplicate what we're doing. So the differences are very much from the standpoint of going from conventional to unconventional resource plays and having repeatable success versus an acquisition-driven environment as in the 80s and 90s.
Well, good luck to you this go-round.
Well, thank you so much.
It's been a pleasure having you here today.
Thank you.
I'm Quinn Nguyen for OilAndGas360.com.